mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome back, everyone. Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. The first one today is from Jody. She says, I'm behind on investing. I wish I had saved more. But the biggest problem is that I'm 5 years from retirement and I also hate risk. What should I do? All right, so here are the factors you have to think about, Jody. Okay, number one, if you were to make a change now, right, and get zero growth, reinvest and have, let's say, you can get 5.5% today of income. So whatever amount of assets you have, assume that you get 5% of income, and that income will grow by 5.5% for the next 5 years. Now you have to ask yourself, will that bring, where will that bring you in from an income point of view? Can you get by on that? And if it's not enough, then you might have to figure out, okay, how many more years does that have to grow at 5.5% to get to where you can, stand to retire? Because it might be a 3-year postponement or a 5-year postponement, and you might say, you know what, I'm healthy enough, I'm willing to do that, I'm risk averse, I don't want to take the risk, I don't want to be stressed about my money. So if it means making the change first, and I know I've got to work 5 more years, I can wrap my head around that, right? Then, I think that's a good thing, right? And most people are fine if they can wrap their head around it and they know they've got to work 5 more years. It's when you plan to retire and all of a sudden the market drops, you haven't made that transition quick enough to an income first, growth second approach, and now your head's not kind of fixed and wrapped around it, and all of a sudden you have to work for 5 more years. That can be rough. But if these are the cases where it takes a few more years, then I think you're fine, right? If it's more than that, then you're not fine, right? Then one of the things you might want to consider, Jody, is you might want to consider, high dividend common stocks, right? You can get into higher dividend common stock strategies. You won't be getting as much income as you will if you owned bonds or preferreds or things like that. But at least you can get more income than you're probably getting in your portfolio today and still have a lot of upside potential. And if the market goes sideways and takes a major drop, at least you should be somewhat cushioned, because those high dividend stocks tend to drop a lot less than growth stocks. So if you're, talking about, if I make the transition now, I'm pushing retirement out 10 to 15 years and I'm unwilling to do that, but I'm also unwilling to take risks, then maybe a compromise is higher dividend stock strategy. That gives you a chance to get out a little bit earlier without taking as much risk. So you're kind of taking a little bit of risk and maybe working a little bit longer, but it's not extreme on either end. Let's dive a bit deeper into some specific strategies for investing for income when you're behind on saving and close to retirement. One approach is consider a bucket strategy. This involves dividing your portfolio into 3 buckets: short term, 1 to 2 years of expenses; medium term, 3 to 10; long term, 10 plus. The short term bucket could be in very safe liquid investments like high yield savings accounts, short term bond funds. The medium term bucket might include a mix of bonds and dividend paying stocks. The long term bucket could have a higher allocation to stocks for potential growth. Another option is to explore annuities, right? Particularly fixed or indexed annuities. These can provide a guaranteed income stream in retirement, which can be reassuring if you're risk averse. However, be sure to understand the terms, fees, potential drawbacks before committing to an annuity. You might also want to, look into real estate investment trusts, REITs. These can provide steady income through rent collection and potential for capital appreciation. They're more volatile than bonds, but less so than many stocks, potentially offering a middle ground for your risk tolerance. Lastly, don't forget about maximizing your Social Security benefits. If you can delay claiming until age 70, you'll receive a significantly larger monthly benefit, which can help offset your savings shortfall. Remember, Jody, it's never too late to improve your financial situation. Even small changes now can make a big difference in your retirement income. Consider speaking with your financial advisor or a financial advisor who can help you create a personalized plan that balances your need for income with your low risk tolerance. And Jody, thank you so much for sending in this question. It is a common concern. People don't always talk about it. I hope this advice helps you navigate your path to a comfortable retirement. So that's a great question. And as always, if you'd like to send in your questions, you can do so by emailing them, just like Jody did, to poollocke@poollocke.com. Moving on to our second question, it's from Mark. He asks, even if I refinance my investments and I lock in rates right now, I know that companies can still default. So how do I protect against that? So Mark, how do you know you're secure? That's what you want to know. Again, if you're a creditor and you have to look at the creditworthiness of the borrower, right? So, you just like you have a FICO score, right? I have a FICO score. We all have FICO scores, but if you pay for everything in cash, right, you don't really need a FICO score. It doesn't really matter, right? But we have these FICO scores, and what the FICO score is, it's a numeric assessment of your creditworthiness. And of course, if you have an 800 FICO score, then you can just borrow at the best interest rates at any given time. Right now, the best mortgage rate might be low sixes, and you can borrow at that rate. But what if you had a FICO score of 650? Well, you might still get a mortgage, but now it may not be low sixes, it may be low sevens or mid sevens. So generally speaking, the riskier, the bigger chance of default from a borrower means that the interest rate is going to be higher. Now, if you're conservative, and it sounds like you are, Mark, where you don't want to worry about defaults, then you've got to go with those that have kind of that higher FICO score, right? Only in the investment world, it's not called FICO score, right? It's called a rating. So you have Moody's, you have Standard & Poor's, you have Fitch, which are the three biggest rating services, and they rate each bond and preferred stock at 15 to 25 different levels, and you want to be on one of those higher levels. So it's not like the FICO score that maxes out at 840, it's a different letter grade, but you're going to want to stick to one of the higher ones, right? And if you do that, then you're probably going to feel comfortable no matter what happens. Now, if you're willing to take a little bit more risk because it's still, you're the creditor, right? So you still have some rights. You're still a person that made the loan, and you want to take some risk, then you might want to kind of slide down the scale just a little, and you might get a higher interest payment or higher dividend payment in the case of preferreds. So when it comes to investing for income and protecting against defaults, there are a few more strategies that you might want to consider. One important approach is diversification. Don't put all your eggs in one basket. Even if that basket has a high rating, spread your investments across different companies, sectors, types of income-producing assets, things like that. You might consider a mix of corporate bonds, government bonds, dividend-paying stocks. Each of these, comes with different levels of risk and potential return. Government bonds, especially those from stable countries like the US, are considered among the safest investments, though they typically offer lower yields. Now, another strategy to protect against defaults is to invest in bond ETFs rather than individual bonds. Now, you would only do this if you didn't have the assets to diversify over individual bonds directly. So these funds have a variety of bonds, which helps spread the risk. If one company in the fund defaults, it won't impact your investments as much as if you held that company's bond directly. Now, I usually say the threshold for holding individual bonds is $100,000 and up in investable assets. Below that, you might start to consider bond ETFs for diversification. You might also want to look into Treasury inflation protected securities, TIPS. These are government bonds that are adjusted for inflation, which can provide additional security in times of rising prices. While they may not offer the highest yields, they can be a stable part of an income-focused portfolio. For those willing to take on a bit more risk for potentially higher returns, consider investing in preferred stocks. These typically offer higher yields than common stocks or bonds from the same company, and they have priority over common stocks in the event of a company's bankruptcy. Lastly, don't forget about the power of laddering, especially with bonds. This involves buying bonds with staggered maturity dates. As each bond matures, you can reinvest at the then current prevailing rate. This strategy can help manage interest rate risk and provide a steady stream of income. Remember, Mark, while it's impossible to completely eliminate the risk of defaults, these strategies can help mitigate that risk while still allowing you to generate income from your investments. It's always a good idea to consult with a financial advisor to create an income strategy that aligns with your specific risk tolerance and income needs. So, Mark, hope that helped. Hopefully that answered your question and gave you some additional ideas for protecting your income investments against default risk. Thank you so much for that awesome question. If you want to have your question answered like Mark, you can do so by emailing in to poolelock@poolelock.com. And if you like what you heard, go ahead, like and subscribe to our channel. I'm James Locke, your retirement income source. I'm going to talk to you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.